No me compraría que ahí mismo, tranquilo. La de André puede, pero la mía no.
Okay. So after class today, I'm going to open up the Google shared spreadsheet for the final exams for you to sign up in case you want to take either the 16th or the 18th. You don't have to do it right away if you're not sure yet. I'll leave it open probably till the 9th or the 10th of December, so you'll have a few days to decide what you want to do. One thing to remember about the 16th is our last class is on the 14th. The project is due the 14th, the exam's on the 16th. You got to work it in terms of your time schedule as to whether you'll have enough time to prepare for the final. Okay? It is a 2-hour open book, open note final that will cover everything, which is a lot. So to the extent that you've been preparing for the quizzes, the one good thing is that 60% of the final will be on stuff we've done since the last quiz, which is kind of strange because there'll be only, 5 sessions, I think. But the reason I can get away with it is the stuff we do after the quiz. Things like acquisition valuation, you have to remember cost of capital, cash flows. They build on what we've already done. But 3 of the 5 problems will come. So we'll talk a little bit more about the final as it gets closer. But what I want to start with today is actually something we ended last class with, which is these undeveloped reserves as options. And I talked about real estate being an option and undeveloped oil reserves as being an option. What I want to start with is a very simple example of why we care. You're saying, no, this is all nice. I'm never going to use an option pricing model. Why should I care? Let's take a very simple example. Let's suppose I gave you 2 companies. Right? I don't know why the text went the other way, but forget about what's on the text. I've given you Royal Dutch and Petrobras, both oil companies. But here's where they're going to be different. Royal Dutch gets most of its value, 90% of its value from developed reserves. Why? It's been around a long time. It has a lot of reserves that are throwing off oil, only 10% from undeveloped reserves. Petrobras gets 20% of its value from developed reserves, 80% from undeveloped reserves. For the moment, set aside all those other concerns you have about Petrobras on the back burner. The corruption, the Brazilian government issues, all of those, let's ignore it. Let's think of them as two oil companies. So different companies in terms of where they get their value. Let's suppose the oil price is $60 a barrel and you value both companies. For the moment, again, let's act as if both companies have the same value right now at $60 a barrel. Okay? So let's try something different. Let's assume that there is a crisis in the Middle East, and this is not even an assumption. There's always a crisis in the Middle East. The question of what that crisis is, how big the crisis is. In this case, let's say that that crisis causes the price of oil to go from $60 to $100 per barrel. First, let's take the easy question first. What will happen to the values of these two companies? They're going to go up. Are they going to both go up by the same? I mean, they were the same value at $60 a barrel. The price per oil has gone up to $100. Will they go up by about the same? There are two components to value, right? So which portion, which company is going to go up more, you think? Why? But in a sense, in this case, they'll both go up, but the developed reserves, you get the $40 more per barrel. The undeveloped reserves, you might get a time premium. The question of whether the undeveloped reserves will go up in value is not a question of whether the price has gone up to 100. It's what you perceive the volatility of oil prices now to be at a higher price. Okay? So let's say they've both gone up. Good news, right? The day after this crisis, the crisis goes away. Just like many Middle Eastern crises come and go. This one's gone. The price drops back to 60. Remember, it was 60 before this crisis. Right? So the prices drop back to 60. Would you expect the prices of both companies to revert back to what they were before the crisis? You see where I'm going? The level of oil prices matters, right? In this case, the level of oil prices basically goes back to what it was. What's changed after these 2 days? What's the volatility? It's not a backward-looking number, it's a forward-looking number, right? When you get a crisis, what do you get a reminder of? That expected future volatility might be much higher than past volatility. Which means after this crisis, when you look at the two companies, magically Petrobras is going to now become a more valuable company, even though the prices have gone back, because the volatility of oil that's driving the value of the undeveloped reserves, and that will dominate the price effect. So when you think about commodity companies, think about the level, that's critical, but also think about the volatility in that price. So whether you're looking at a Glencore or a Petrobras or Rio Tinto, it's not just the level of commodity prices that should be concerning you, it's how much uncertainty there is about those prices. Okay? In fact, let's do one final thing, and this is more to get a technical detail nailed down. Let's assume the Petrobras decides to auction off its undeveloped reserves. After all, it really needs a lot of cash, right? And of course, there's a nationalistic component now, because all of Petrobras' reserves are in Brazil, and the Brazilian government obviously feels that this is something that belongs to the nation. This is actually something that's a factor around the world now. Lots of governments feel they can't give away the reserves. So what the government says is, look, you can auction off these reserves on one condition. The person getting these reserves will get them, but if oil prices climb above $150 a barrel, which there's a chance they might, then the excess profits they make above the 150 has to be given back to the government. So let's start with a simple question. If you're looking at the auction value of these reserves, right, will that auction value be affected by this cap that I've put on the price? It's an easy question, as I said. Yes, will it lower the auction value or increase the auction value? It'll lower the auction value because, can you estimate how much lower? What would you have to do?
Make a collar.
And how would you value it? Let's say if I asked you to value the call, so what exactly would I need to do?
You have a call based on the current price in a foot.
Okay. So the reason I want to bring this up is not specifically with this, but all too often in finance we see options with a cap or a floor don't get confused about what to do next. It's very simply two options you have to value. One is a call option with a strike price of 60. The other is a call option with a strike price of 150. The difference between those two values will now be how much you value these undeveloped reserves at. Remember I valued Gulf Oil's 3,038 million barrels as an option? That was with no cap. If I now introduce a cap and say on average at $100 per barrel, Gulf Oil will have to turn over all its profits to the governments of the countries where these reserves come from. You'd have to value a second call option with a strike price of 100. Obviously, that call option is going to be worth a lot less than the call option at today's price. It's the difference between those two numbers that's a value of any kind of option with a cap on it or a floor on it. So either way, you can value caps and floors. Okay? It's very common in fixed income to see these caps and floors. You don't see them as often in valuation, but if you do run into a cap and a floor, at least now you have a technique for dealing with it. So let's go back to the notes because I want to talk about one final option in this game. And that is the option to abandon. So I'm going to start with a personal question. Okay? And you're welcome to evade the question if you need be. How many of you have taken a job offer already? Okay? How many of you are absolutely sure that this is the job for you for the rest of your lives? Okay. Wouldn't it be nice if you had the option to abandon? The option to abandon basically means you take a job, you find out 6 months later that the job is not your job, you walk away from it. Anytime you enter into a long-term commitment, the option to abandon comes into play. A few weeks ago, my wife and I met with an old friend of ours who has been going out with this person for 15 years. And she was moaning about the fact that he never proposes, that he's never going to get married. And forgive me for this, but all I could think about was options to delay. So her whatever you want to call her soon-to-be ex or spouse or whatever, is using the option to delay. You can see why, right? The option to delay. You can, and then I'm worried about what happens if that option to delay get exercised, because then he'll create the option to expand, which is having affairs on the side. And of course, there's that final option to abandon, which is divorce. Life is full of options. Some are not pleasant. So the option to abandon basically reflects the fact that when you as a business make a big investment, you always worry. You're never sure that you're going to make money. It's always nice to have the right to be able to walk away from a mistake. That's basically what the option to abandon is. It is the one real option that's a put option, because you basically get the right to walk away at some lower price. I'm giving you a put option. Again, it's very abstract, so let me give you a very simple example of how this plays out. So let's assume that you're Airbus, right? The European aircraft company, and I'm Lear Aircraft. I usually, my prime business is corporate jets, but I want to produce this 50-passenger, regular commercial aircraft. I don't know how to do it. So I come to you and say, hey, let's enter into a joint venture. We're each going to put in $500 million. So Airbus is going to put in $500 million. No, I'm going to put in $500 million. And we're going to have a joint venture to produce these smaller commercial aircraft. And of course, as Airbus, you grind through the numbers. And let's assume that based on grinding through the numbers, the present value of the cash flows you think you can get from this project is $480 million. So already what have I told you about this investment? It is a negative. So you say, no, I'm not interested. But I really, really want you as a joint venture partner. I say, look, if you become my joint venture partner, any time over the next 5 years, if you change your mind, I'll buy your 50% share from you for $400 million. You already invested, you're investing $500 million, right? So I'm offering you less than what you've invested, but I'm also offering you then a floor on your losses. You cannot lose more than $100 million because I'm offering you the right to buy your share at $400 million. I've given you a put option. Do you see why it's a put option? If you decide any time over the next 5 years that this joint venture is not working for you, you can sell your share and walk away. Would you sell your share today? What do you get if you sell your share? You get 400 million. What's the present value of the cash flows? 480 million. So right now it doesn't make sense for you to sell your share. But if things collapse on this joint venture, nobody's buying an aircraft, a year from now or 2 years from now, you can come to me and say, hey, look, I'm selling my share back for 400 million. The project itself is a 30-year project. Now, let me ask you a question. Why did I give you this right to sell your share back only for 5 years? Why didn't I give it to you for all 30 years? What would happen if I gave you the right to sell your share for 400 million any time over the next 30 years? What would you do? Even if it's a great project, you're going to wait till 29 years and 364 days have passed, check your calendar, and early on the very last day of the 30th year, you're going to show up in my office saying, you know what, I never liked this project. Please. So if you're going to offer this option to somebody else, make sure you don't offer it for the entire life of the project. It's going to be deadly. It's a 30-year project, but the option is only for 5 years. So let's see how much this put option is worth. And to estimate the value of the put option, I'm also going to give you one more piece of information. This 480 million in present value of cash flows that you have today is going to change over time. Why? Because you're going to find out new things about the market, new cost structures. It could become 750, it could become 300. The variance in the present value of the cash flows is 0.16, which means the standard deviation is about 0.4. How did I get that? I ran a Monte Carlo simulation on the present value and I ended up with this variance. Let's plug the numbers in. The present value of the cash flows becomes the equivalent of the stock price. That's what you would get if you took the project today, so that becomes S. The strike price is what you will get if you turn your 50%, so that becomes the strike price. The variance is 0.16. You have 5 years to play this game. And because this is a finite life project, you know what I mean by a finite life project? It's a 30-year project. It's going to become 29, 28, 27. The project value is going to decrease each year because you have fewer years of cash flows left. So that becomes the cost of delay or the dividend yield. The five-year risk-free rate is 6%. I plug the numbers in, I get a value for the put option of 73 million. Now remember, you are Airbus, your negative net present value originally was minus 20 million. That's why you turned the project down. I've now offered you a put option worth 73 million. If you add the two numbers up, your net present value, including the put option, is going to be minus 20 plus 73, which is plus 53 million. It's no guarantee that you will become my joint venture partner, but I've tilted the scales in favor of you joining. This is something that happens all the time in joint ventures, where a reluctant partner is pulled in by being offered options. Options to get out, options to expand. So I accomplished my goal, right? As Lear, I got you to be my joint venture partner. What do I need to check to make sure that this is in fact still a good deal for me? I gave you an option worth $73 million. This project better have a net present value greater than 73 million to me for me to be giving you this put option. So I might end up giving you this getting into this joint venture with you, but if I've given away too much in that put option, it's a bad investment for me. So options to abandon are put options, and you see this all the time in investments. In the case, we'll talk a little bit about venture capitalists in. Come on in. It's okay. Don't worry. Yeah. Venture capitalists in young companies, and often you see them add options onto the investment to see what happens in the investment. Almost all of those options, whether they're options the downside or the upside, have to be factored into the investment. So here are the implications for investment analysis. Having the option to abandon can make bad investments into good investments, especially if they're really long-term and big investments. And when people talk about flexibility, you often hear about this in strategy classes, let's preserve flexibility, you hear about it in companies. When I hear the word flexibility, I think put options. Because that's what flexibility is, the capacity to be able to walk away. And if you think about things you can do as a company to keep these options valuable, here are some of the things you might want to do. You might want to build in less fixed costs, more variable costs. It allows you to walk away from your mistakes much more quickly. Don't tie in too many long-term contracts, because then walking away from an investment becomes more difficult to do. So some of the things that you view as reducing risk, Because all too often in companies you have people saying, let's enter long-term contracts. It reduces our risk. It reduces one type of risk, but it increases a second type of risk. You want to preserve your option to abandon, especially in very uncertain businesses where you're not sure what tomorrow will bring. Okay? Now let's talk a little bit about options in capital structure. How many of you were in my corporate finance class? Yeah, most of you. Remember that capital structure section? Act like you do. Yeah, yes, I remember it intensely, like it was yesterday. But in the capital structure section, here's what I made you do. I forced you to do it. You didn't want to do it, but you had to do it. Where I said, find the optimal mix of debt and equity for your company. Would somebody want to tell me how you did that, or how I made you do that, in case you don't want to claim ownership? How do you come up with the optimal mix of debt and equity for your company? What did I ask you to do? Change the mix of debt and equity, check what happens to your cost of capital, and the point at which your cost of capital was minimized was your optimal debt ratio. And at the very last session of that class, I showed you what you found, and I think 81% of the 308 companies in the class were under-levered. Under-levered in what sense? Their actual debt ratios were lower than their optimal. So if you can remember the company you did, try to think back of what you found. That the actual debt ratio was 12%, the optimal was 40%. Which left this gap, right, between the actual and the optimal. And of course, the follow-up question is, why the heck are they doing this? If they can borrow more money, how come they don't? And this actually, when I first started doing corporate finance, was one of the most frustrating issues to me in corporate finance, which is you come up with an optimal, there'd be an actual debt ratio. The actual debt ratio would be 5%, the optimal would be 40%. So it wasn't even a question of uncertainty about there being debt capacity. You'd go to the company and say, you have the capacity to borrow money. And their response would be, we know. But we're not going to use it. And if you ask them why, they'd use two words, financial flexibility. And who can argue against financial flexibility? This is like motherhood and apple pie, right? Well, of course, it's a good thing. So the first few years, I'd let them slip by with this. So finally, I started asking the question, financial flexibility to do what? So let's think through this. Why do companies want to preserve debt capacity? To maintain flexibility to do what? What do they want that capacity to borrow money? What do they want to use it for? For a great investment in case it comes along, right? That's basically what they're talking about. So that, in fact, opened the door for me to start thinking about financial flexibility as an option. And here's the way I frame it. If you have unlimited access to capital, you don't need financial flexibility because you can always go out and raise as much capital as you want to take every project you can, right? But if you have restrictions on raising capital, either internally imposed or externally imposed, you can see the rationale here. You want to maintain that $5 billion excess debt capacity in case that great project comes along. You see how this starts to look like an option? If you think about it in terms of option, the value of flexibility is by using this debt capacity, you can now take great projects you otherwise couldn't have. The value of that option, if it exceeds what you lose by being under-levered, means that you should stay under-levered. So it actually allows an opening for companies to say, look, I know we borrowed too little money. I know our debt ratio is below the optimal, but we're okay with it because the value we lose by staying under-levered is less than the value we gain from the option we get to take great projects. Already, let's start dispensing with this argument for some companies. If Yahoo said they were under-levered, and the reason they gave you is we want to maintain this debt capacity in case a great project comes along, what's your answer? What great project? Give the money out or borrow the money now, right? If GM came along and said, look, we're going to preserve debt capacity in case a great project comes along, you're saying, what great project? You're in a bad business and getting worse by the moment, so why should I give you the capacity? If Google came along and said, we want to maintain debt capacity in case a great opportunity came along, you're much more willing to listen, right? Of course, the pushback you would have against them is, hey, why can't you go raise capital? And that's actually the pushback but if it's a smaller tech company, even that pushback you're going to find very quickly is that company might not have access to capital. So you can already see that the value of financial flexibility is going to vary across companies, and how much it's worth is going to depend on what kind of investment opportunities you have as a company. The greater the investment opportunities, the greater the potential, and how much access you have to capital. So here's how I'm going to structure it as an option. Let's assume that there's a certain amount of reinvestment you can cover just with the internal funds. You know what I mean by internal funds? Retained earnings, normal access to working capital. So this is what, $1 billion every year, no problem, I can cover it. If your actual reinvestment needs exceed that normal amount, then you have to come up with the extra amount, right? Having excess debt capacity comes into play when that happens. So if you normally can raise $1 billion and you find this great investment that requires $10 billion, having a $25 billion excess debt capacity is going to allow you to take the projects. And if you do, the value you're going to create is the excess returns you're going to get from taking that project, the net present value of that project. So the value of having excess debt capacity shows up by being able to take these new investments that come about that require far more money than you can normally raise. Are you guaranteed that a new investment will come along? Not at all. In fact, if no investments come along, then the cost you face is that you were under-levered to begin with. So by having this excess debt capacity, you ended up with a higher cost of capital. That becomes your cost of maintaining financial flexibility. So I'm going to use a company that you should be familiar with if you were in my corporate finance class, which is Disney. And I'm going to go back to 1997, my first edition of the Disney, of looking at Disney, to take a look at how much excess debt capacity was worth for Disney. So at the time that I looked at Disney in 97, its actual debt ratio was 18%. 18% debt, 82% equity. Its cost of capital was 12.22%. If you look at the schedule, this is my cost of capital schedule as the debt ratio changes. And I'm being realistic. As I borrow more money, my cost of equity climbs and my cost of debt climbs. But my cost of capital is minimized at a 40% debt ratio. At a 40% debt ratio, the cost of capital for Disney is 11.64%. So right now, they're at 18% debt with a 12.22% cost of capital. If they move to their optimal, their cost of capital drops to 11.64%. So they're going to be able to save about 0.58% a year by moving to their optimal. So the cost of maintaining excess debt capacity to them is 0.58%. So let's say I try this out in Disney. They say, no, we need to maintain financial flexibility. I'm going to try to value financial flexibility on an annual basis and see if, in fact, the annual value of financial flexibility exceeds 58 basis points. If it does, then they should stay under levered. If it's not, then they should go out and borrow the money. So here's how I set up the option. For the value for the S in the model, I looked at how much Disney reinvests every year as a percentage of its value. And the way I measured reinvestment is by looking at net capex and change in working capital. So I took that every year, looked at it as a percentage of firm value. So that number is going to reflect both how much they reinvest and how much uncertainty there is over time. So the uncertainty I captured by the variance in that number. So they reinvest 3% every year. Then the standard deviation is going to be 0. They probably don't need excess debt capacity because it's very predictable. But if they invest 3% in 1 year, 21% the next year, minus 5% in the third year, plus 16%, you're saying, when would that happen? If you grow through acquisitions, your reinvestment needs are going to be a lot more volatile. So I measured that as a variance in the reinvestment needs. For the strike price, and this is going to be the controversial part, I looked at their retained earnings each year, how much they were able, as well as their normal access to debt. They borrowed a certain amount each year as part of their regular operations and computed that as a percent of value. Already I'm building into the model the assumption that there's a capital constraint. I'll tell you the basis for this constraint for most US companies is why do most US companies fear issuing new shares? What is it that keeps them from issuing new shares? Come on, it's that magical word that analysts like to throw around anytime they want to scare you about new shares. It is dilution. US companies are terrified of dilution. As a consequence, they refuse to issue new shares. It's a completely irrational constraint because if you have the greatest project on the face of the earth, there's nothing wrong with issuing new shares to take it, but for whatever reason, they don't want to do it. So this capital constraint is probably more internally imposed than externally imposed, so we can come back and test it. But I've assumed that that's going to be their strike price. So essentially, that's their normal reinvestment amount. So they're reinvesting about 5.3% a year. The variance in that number is 0.375. The reason it was so high for Disney is in one of these years, they actually bought Cap Cities. See why that's going to make a difference? That's an $18 billion reinvestment that makes a reinvestment jump through the roof. And finally, I'm going to measure the value flexibility over 1 year. So I plugged the numbers in, and I came up with the value for the option. I'm almost home. I now have the value of the option to take a new investment. But that new investment creates value for me only if I earn over the cost of capital. So as the final piece of this, I looked at what Disney was earning as its return on capital on its existing investments. It was earning about 18.69%. Its cost of capital is 12.22%. So basically, it's earning a 6.47% excess return. I made the assumption that this new investment that they haven't even seen yet is going to earn roughly the same excess return. My value for the option is going to be that excess return scaled to the cost of capital, which gives me a value of financial flexibility each year of 0.85%. So what's the price they're paying by being under-levered? 0.58%, right? Because their cost of capital is 0.58% higher than it should be. What are they gaining? If you buy into my assumptions about capital constraints, they're getting back 85 basis points. The bottom line is, if you buy into these numbers, you're not going to push Disney to move to its optimal. You're going to let them stay at where they are. And if you look at what's driving this, it's driven by a couple of things. One is obviously that capital constraint. If I went back into this option pricing model and I made them have unlimited access to capital, what's going to happen to K? K becomes infinity. If you put in an infinite strike price, the value of the option goes to 0. So if I put in this traditional corporate finance assumption of, hey, you can raise capital whenever you want, the value of financial flexibility goes to 0. The second factor that drives the value of the option is the 6.47% excess return. If I made that 0, if I made the assumption that they earn their cost of capital, the value of financial flexibility also goes to 0. That's why for Yahoo or GM, I'm not going to give a value of financial flexibility. It's because I don't think they can make more than their cost of capital on new investments. Again, it's not so much about the numbers, but the implications. Because if you buy into this notion of financial flexibility being an option, you can make some predictions about what kinds of companies are going to stay under-levered. What kinds of companies are going to be unwilling to borrow money. And as I go down this list, start thinking about types of companies that are going to be affected. The more constrained you are in raising capital, the more under-levered you should be as a company, because the greater the value to financial flexibility. So private businesses should be more under-levered than publicly traded companies. Why? Because private companies don't have the access to external markets. Emerging market companies should be more under-levered than developed market companies. In fact, they might push their debt ratios not just down to 0, but keep going. How do you make your debt ratio less than 0? Once you hit 0, how do you keep building up your financial flexibility? They build up cash. Your net debt ratio could become a very negative number. If you're truly capital constrained, that's exactly what I'd expect you to do. So think about companies that are capital constrained. Small companies should be more under-levered than large companies. The more you make capital markets accessible, the more companies are going to borrow, because in a sense you made it easier for them to overcome that capital constraint. Second, the more unpredictable your reinvestment needs, remember that variance that entered into the option, the more under-levered you should be. So a company that grows through acquisitions needs to maintain more excess debt capacity than a company that builds a factory every year. And finally, companies in good businesses should be more under-levered than companies in bad businesses. So if you're in the technology business, you can earn 15% more than your cost of capital. I think it makes sense for you to stay under-levered. So the next time you're Carl Icahn, jump on a technology company but not borrowing more money. This is one of those cases where it might actually make sense for a young technology company or a small technology company to say, look, we're going to stay under-levered, not because we don't know the benefits of debt, but because the value of financial flexibility exceeds whatever we lose by staying under-levered. Any questions on financial flexibility? Which brings me to the final piece of this options section. Earlier I said that, in the email that I sent out, I said very few of you will be able to apply this option pricing approach in valuing your company. In fact, I got at least 3 emails over the weekend from people valuing oil companies that tried to value their oil companies using the option pricing model. We talked about it on Monday. They were ahead of the game. They were doing it even before I talked about it in class. And the problem they were running into is the inputs you need to value an oil company using the option pricing model, remember the Gulf oil, is I need to know all of your undeveloped reserves. And the first problem they were running into is when they looked at their annual reports, they were not getting all of the undeveloped reserves, they were getting only viable reserves, which is like in the money options, right? If you believe the viability. Second, you need the strike price, the cost of developing the reserves, and there was very little information on how much it would cost to develop. You could have made assumptions, but you'd be stretching. So the reality is that most of you, even if you're looking at pharmaceutical companies or young biotechnology companies or oil companies, can talk about options, but you really can't put a number because you need access to internal information. You could do it within the company, but it's very difficult to do it from without. But here's the one place where you might be able to use option pricing. Think about what makes equity different from debt. So let's say I start a company. Your equity investors, your lenders. Equity investors get a residual claim, right? What's the essence of a residual claim? You're not guaranteed a dividend. You're allowed to take out whatever's left over. It's a residual claim each year in terms of the cash flows you get. And if you liquidate the company, how does this work? You sell off the assets. And what's the first thing you need to do? Unless you want to break the law, you got to pay off the debt. And whatever's left over, if any, goes to equity investors. So the first feature of equity is it's a residual claim. The second feature of equity in publicly traded companies and in some private businesses is this notion of limited liability. What does that mean? So let's say you liquidate your company. You get $1 billion from liquidating the company. You owe $2 billion in debt. What do you have to do with limited liability? You take the billion, you pay it out. You're still $1 billion in the hole, right? But because you have limited liability, you say, that's it, guys. And you walk out. Of course, the lenders are pissed off because you live in a big house on a big island. They can't come after you for your personal assets because the nature of limited liability is I cannot push you below zero. And thank God for that. There are stocks I've invested in where I said, thank God zero is the floor. Because I can think of scenarios, the broker keeps calling and saying, you owe me $7 more, $15 more. We're minus $28 now. Okay? So it's those two characteristics that allow me to think of equity as a call option. So to kind of put some structure on it, let's think of it this way. This is an option to liquidate. You have the equity investors, you have the lenders. If the value of the assets you get from liquidation exceeds the face value of the debt, you get to keep the difference. If that doesn't happen, then you lose whatever you originally paid for the stock, and I can't make you pay anymore. So the limited liability shows up in the limited losses because the most you can lose is what you paid for the shares, and potentially you could make an unlimited amount of profit. I'm going to use that insight to kind of value equity as a call option, but be very careful. This is the option to liquidate that you have with every publicly traded company. So it prevails in every company, but in 95% of companies, we're going to argue it's going to be suboptimal for you to liquidate. Because if you try to liquidate Apple or Google today, the value of the option to liquidate is very small, but in some companies, it could be substantial. So what I'm going to do is create a very simple hypothetical example. And as I go through this example, you're going to see me make assumptions that are patently unrealistic, but I'm okay with it. Because in the initial example, I want to keep it as simple as possible. So here's what the company looks like that I'm going to value. It has assets that you're currently valuing at $100 million. So basically, you know the value of the assets. It's $100 million today. That value, though, is going to change over time. Why? Because there are macroeconomic and microeconomic variables that drive that value. Let's assume that the standard deviation in that value is 40%. What does that mean? The 100 could become 180 next year. It could become 20, depending on good things or bad things happening. This company has only one zero coupon bond outstanding. That is all of its debt. The zero coupon bond has a face value of 80 million and is due to expire 10 years from now. So already I want you to pick a side. You can either be the equity investors or the lenders. I can tell you which side is going to be more fun, but I'll let you decide. Okay? So you can either be the equity investor in the company or the lenders in the company. The value of the assets is 100 million and it's volatile. Your one zero coupon bond with an $80 million face value. The 10-year bond rate right now is 10%. So I've given you the value of the assets. I've given you the one debt that you have outstanding, an $80 million zero coupon bond, and I've given you the 10-year bond rate. I'm going to argue that with that minimalist information, you should be able to tell me how much the equity in this company is worth. I haven't given you cash flows, cost of equity, discount rates, nothing. And you should also tell me what the right interest rate should be on the debt of the company. So depending on which game you want to play, I'm going to argue that you should be able to answer each of those questions with the information I've given. I haven't given you a rating, default spreads, nothing. You want to try? Let's start. Let's think of it as an option. So if you're the equity investor, you own the call option on the call option being the option to liquidate. The value of the assets today is $100 million. That becomes the equivalent of the stock price in the model. If you decide to liquidate, what do you have to do? You've got to pay off the debt. I'm going to assume you've got to pay off the face value of the debt. That you can't say, you know what, I'll give you the present value. If you liquidate, you've got to pay the entire $80 million. Again, I'm going to keep it simple by making that assumption. So that becomes the strike price. How many years do you have to play this game? As the equity investor, you get to play this game for the next 9 years and 364 days. Let me pause and ask you, why did I make this debt zero coupon debt? If I issued regular coupon debt as the equity investor, what do you have to do in addition to making the principal payment 10 years from now? You're going to make interest payments every 6 months, right? If I do that, this option is no longer a 10-year option. It's a 6-month rolling option because if you miss any coupon, so in a sense, I've maximized your power as an equity investor by making this a zero coupon bond. Again, for simplicity, I've kept it at that. So that becomes the life of the option. The variance in the value of the assets becomes the variance in the option pricing model, and the riskless rate is 10%. I've got S, K, R, T, and sigma. I can go to town with the Black-Scholes model here. And if I put in the numbers, here's what I get. N of D1, D2, N of D1, N of D2. Remind me again what N of D2 tells me. There's a 63% chance of what? That S will be greater than K. What's S here? The value of the assets. What's K? The face value of the debt. There's a 63% chance that the value of my assets will exceed the face value of my debt, which means there's a 37% chance of what? What do we say when the value of the assets is less than the face value of the debt? What do we characterize that as? Bankruptcy, right? Default. There's a 37% chance of default in this company. It's a very different way of thinking about default than the conventional way with a rating and default spreads. This basically uses an option pricing model to come up with the probability of default at the company. In fact, there's an outfit called KMV. It's a West Coast-based outfit that banks can take their loan portfolios to. And KMV, for a fee, will give them a probability of default on the loan portfolio. What KMV uses fundamentally is an option pricing model very similar to this. It's a much more sophisticated bells and whistles, but it's the same structure. They come up with an ND2, just like we did, and 1 minus that number becomes the probability that they attach to the loan portfolio. And for that, they can charge tens of millions of dollars for doing that service. But basically, it's an option pricing view of liquidation risk. There's my probability. You plug the numbers in, the value that I get for the call is $75.94 million. You say, what does that even mean? The equity investors in this company have a call option, the call option to liquidate. I've just valued that call option at $75.94 million. The value of the assets is $100 million. If the value of the equity is $75.94 million, the difference is the value of the debt, right? It's a zero coupon bond. So if I know what the face value is, I know what the value is today, 24.06, I can solve for the interest rate on the loan. So I've answered both questions. The equity is worth $75.94 million, and you will charge a default spread of 2.77% over the risk-free rate for investing in this loan because of the risk that the company will not make it. It's a very simple example, but I'm actually going to use it to kind of illustrate two very simple follow-up implications that might challenge basic propositions in corporate finance. Let's start with the first one. So let's say you bought the equity based on my recommendations for $75.94 million. Bad mistake, because tomorrow you wake up to a news story. And the news story says, look, half your company's been wiped out. Remember it was worth $100 million yesterday? It's now worth $50 million. You had two factories, one in California, one in Florida. Take your pick. One's been wiped out, either a hurricane or an earthquake. And you're not insured. Bad news, right? But I want to bore down on specifics. Yesterday, your equity was worth $75.94 million. I've now wiped out $50 million worth of value. How much will your equity be worth now? And I'll give you the choices. I can drop the equity value by exactly $50 million because that's what the value of the business dropped by. I can drop it by less than $50 million, in which case you have to tell me who else is bearing the losses with you. Or I can listen to my accountants who will probably tell me the company is worth nothing, the book value of equities has become negative, and the equity is worth nothing. Let's rule out, one we should rule out right off the top. Which one of these is a non-starter? You know, given my biases, you know it's always the accounting number, so cross it out. Who cares whether the book value of equity is negative or positive? The question is, will my equity drop by exactly $50 million or less than $50 million? If it drops by less than $50 million, what did I say? You have to tell me who else is there to bear the pain, right? Who's the only other player in this game? The debt holder. Does he want to bear the pain? You ask the bank, do you want to share in this pain with me? What does the bank say? No, no, you keep it yourself. No, but you suck them in, right? And the bank will feel the pain. Why? Because after this $50 million loss, what's going to happen to the probability of default? It used to be 37% before. It's now going to be much higher because you have less assets at play. In fact, here's what I did. I decided to revalue the option with only one change. Same strike price, same life, same risk variance, same riskless rate. The value of the firm is now half of what it was. You can say, how can the variance not change? Remember, there are two factories. Variance is a percentage change. So if I make two factories into one, the variance is not changing, but the value of the firm is halving. So the S in the model goes from 100 to 50 million. I decide to revalue the equity. I'll remind you again what the equity was worth before this catastrophe. It was worth $75.94 million. I revalue the option. I get N of D1, N of D2. What is the probability of default before this happened? 37%. What's the probability of default now? Almost 58.5%. ND1 minus ND2. So that's no surprise. The likelihood that I will default has gone from 37% to almost 59%. The value of the equity, which was $75.94, drops to $30.44. That's a $45.5 million drop in the equity value. So it was bad news for you. Remember, the value of the debt used to be 24.06. It's now down to 19.56 million. So basically, the equity value will drop by 45.5 million. The debt value will drop by 4.5 million. The interest rate on the loan, obviously, the debt will go up because the market value is now dropped to 19 million. But it's basically the optionality coming to play. And I'll make a confession. As I did this, I could not stop myself. Stop myself in what sense? Remember, I dropped the value to 50. I kept dropping it, 40, 30, 20, 10. You know what I was trying to find out? When does equity become worthless? It's a question you often ask about companies that are basket cases where the stock keeps trading. Everybody says, hey, look, this is a terrible company. It's not going to last, but the equity keeps trading. That's the question I was trying to answer. How low does the value of the assets have to drop before the value of equity goes to zero? And here's what it looked like. Equity is an incredibly stubborn instrument. I dropped the value of the assets to 3 million, kept the face value of the debt at 80 million, and equity hung in there. What's keeping equity afloat here? What is it about this world that I've created that keeps equity afloat, even though we would all agree that there's very little chance that this company will actually be able to make it? But that's always the case. But flesh it out. It's the upside plus the fact that you have 10 years to play the game, plus the downside protection. It's hope and a prayer, right? It's the same reasons you buy deep out of the money options. You got 10 years to play the game. You're hoping and praying that something good will happen. Most of the time, nothing good will happen. But if it does, that little 25 cents you paid for the stock might become $50. That's what happened, for instance, with Continental Airlines in 1991. A company that everybody had given up for dead. The stock was essentially trading for penny change. You were buying a company that accountants would have told you is dead in the water. You'd have been getting a company with a double C rating that everybody was convinced was not going to make it. And most of the time they're right. You pay the 50 cents, you throw it into the trash can, but when it does make it back, sometimes does, you get that big upside. It changed my perspective on what bankruptcy actually means. I mean, when I took my first finance classes, I was told that bankruptcy basically means the value of your assets is less than the value of your outstanding liabilities. It's a very accounting definition of bankruptcy. In fact, I didn't learn from this. I actually learned from my daughter when she was 3 the meaning of bankruptcy. She's a brilliant financial genius. Not really. She's a psych major who hates numbers. Okay? But this was when she was 3, and it was a summer that I used to play Monopoly with my sons. They're older than she was. But she wanted to join in. Finally, she's a very persistent little creature. So finally said, okay, Kendra, you can join in. And after about 3 games, I had to ban her. Because she's like a one-person Enron. She would collect $200 when she wasn't passing go. She would put up hotels and properties that didn't belong to her, like Donald Trump. Right? And she'd charge you money wherever you landed. Give me 100, give me 50. I said, Kendra, you're banished. Tiny creature, horrible temper. She starts walking around and saying, you're bankrupt, you're bankrupt, you're bankrupt. And I was very impressed that a 3-year-old would use the word bankrupt. I said, Kendra, what does bankrupt mean? Expecting an answer like the value of your outstanding assets is less than the value of your... She says, bankrupt means you don't get to play the game anymore. And you know what's a perfect definition of bankruptcy? As long as you get to play the game, you're not bankrupt. That's what's keeping the equity afloat, is you have 10 years to play the game. And as long as you get to play the game, you are not bankrupt. But here's the danger. The further and further underwater you get, the more equity becomes like an option, right? And the more it becomes like an option, the more inclined you're going to be to avoid risk or take risk. You're the equity investor, you run the company, you're already deep underwater, you're going to drown anyway. What difference does it make whether you drown in 25 feet of water or 10 feet of water? You're going to take some incredibly insane risks, not even good risks. You're essentially saying, who cares? You might take all the money, take it to Vegas, put it in number 23 and hope it pays off. The odds might be pretty low, but it doesn't really matter. So I'm going to use my second example to illustrate how this will play out in terms of the projects you take. So let's revert back to the pre-catastrophe company. $100 million value for the assets, $75.94 million value for equity, remember the firm as it used to be. Let's assume that I'm a project salesperson. Don't even ask me what this even means. I go around selling people projects. So I come to you with a project. Now you're well versed in corporate finance, so you ask me all the key questions. You ask me, what's the net present value for the project? And I say, minus $2 million. You're well versed in corporate finance, what are you trying to do? Throw me out of your office, right? Say, no, I have more to add. So not only does it have a negative net present value, it's a very risky project. This is making it really good for you, right? In corporate finance, we're taught, risk is bad and negative net present values are awful. Don't take the project. I'm going to argue that in this particular case, if you're the equity investor into the company, you can actually take this project, on the face of it, a bad project, a bad risky project, and walk away with a higher equity value. Let's try this out. Let's see how this works out. So let's assume I revisit the option pricing model. I've now decided to take the project. Because it has a negative net present value, what happens to the value of my firm? It drops by $2 million. So basically it goes from 100 to 98 million. That's bad news. I still owe the 80 million in debt. It's still 10 years. But now because I've taken a risky project, what happens? The variance in value has gone from 0.16 to 0.25. So I've made the firm less valuable but more volatile. Let's see how much the equity is worth with this change. I revalue the equity in the debt in the option pricing model. The 75.94 has now become 77.71. I've increased my value by almost 1.8 million by doing what? By taking a very bad risky project. This is why you shouldn't take a corporate finance class, right? Basically take bad risky projects, your value of equity goes up. Who's losing? The debtor. In LBO sometimes you get banks complaining that they lent money in an LBO. and lost a lot. My reaction is, you deserved it. You lend money on an LBO. You cannot be a passive lender. You know what I mean by a passive lender? You lend money and say, well, they're going to do the right thing. They are going to do the right thing for themselves as equity investors. And guess what? If you have a highly levered transaction, what equity investors that do to make themselves better off can actually make you worse off as a lender. So if you're lending money on a levered transaction, you have to be involved in the decision making of the company. You have to be involved in whether they take projects, what types of projects they take, how much they borrow. It's Finance 101. It comes from the option pricing perspective. It just gives you a different perspective on we talk about this in the context of capital structure in terms of the different incentives on the part of equity and debt. You can see it play out with an option pricing model. So it's a good trick question to ask. Can equity investors ever be made better off by taking a negative net present value project? Yes. Especially if you're a highly levered company with a lot of risk. So it can happen, it happens all the time, and you have, as a lender, it's your job to make sure it doesn't happen, or try to make it more difficult for equity investors to do it. Because left to their own devices, this is exactly what the KKRs and the Blackstones will do to you as a lender. It's not their job to watch out for your interests, it's your job to watch out for your interests. Now let's take another standard thing we're taught in finance and see if it holds up. Let's assume that this company that I just described, let's revert back to the $100 million value, 75.94 value for equity, 24.06 million debt, goes out and acquires another company. Let's say the value of the company acquires 150 million. Let's assume there's no synergy, none of the other stuff, and they pay exactly 150 million. It's a fair value acquisition, right? What are we taught to do with acquisitions? Treat them like traditional capital budgeting projects. So if you get something for 150 million, you pay 150 million, that's a zero net present value investment. So as equity investors in the $100 million company, you say, I don't care. It's a fair value acquisition. Let's see how this plays out on your value of equity. It's a fair value acquisition, but let's see if in fact you are unaffected. So here's your company, company A. So that's the company you're in. There's a company you're buying. They both have debt. They both have the same maturity. They both are risky companies. In fact, the company you're buying is riskier than the company you have. So that's good for you, right? But if I combine the two companies, what's going to happen to that standard deviation in value? It's going to get lower. And it's modern portfolio theory, right? Remember two assets in a portfolio? The variance in the combined firm's values, the weight on the first firm, 40% squared, so 40% comes from 100 divided by 250, times the variance of the first firm, 60% squared times the variance of the second firm, plus this mysterious third term is, of course, the covariance term, which depends on how the two companies move together. And if this is a conglomerate merger, which is in two different businesses, that correlation is going to be well below 1. So the combined companies' variance is going to be a lot lower than the variance of companies A and B. It's not magic. It happens all the time in conglomerate mergers. By combining two companies, you've made the combined company safer. You think, okay, that's good, right? Well, let's revalue the option we had. So basically what you have here is the value for firm A and firm B as standalone companies. And in the last column, you see my valuation of equity in the combined firm. And the value of equity in the combined firm is about $3 million lower than the value of the equity in the two firms coming together. In other words, as equity investors, you lost $3 million even though it looked like a fair value acquisition. Intuitively tell me where that leakage in value is coming from. What's happening in this combined company that's leading me as an equity investor to be worse off after a fair value acquisition? Sorry? It's going to tell me exactly why as a debt holder you're happier after the acquisition than before. So let's say you're debt holders in companies A and B. Now you've got a combined company. Why are you happier after the acquisition? It's a riskier, it's a safer company. And you get to keep the interest rates you charged me when I was a risky company. So if I want to claw that value back from you, there are two ways I can do it. One is to come back to you and say, look, that interest rate we had before, it's no longer the right interest rate. You have to, of course, you're going to say, look, I have the contract here. I'm not going to, in which case I have to look for a second, more insidious way of clawing back value. What's the second thing I can do to claw back value? I'm sorry? Well, that's down the road. I can do something at the time of the acquisition to actually claw back value from you. I've created a safer company, right? So what should I be able to do? I gave away the answer. I should be able to borrow more money. If you're going to create a conglomerate monster as a company, you better be borrowing money along the way and increasing your debt ratio, because if you don't, you're going to be transferring wealth from you to the lenders along the way. So as you go along, you'll be increasing the debt ratio to extract that extra money back from the lenders, because if you don't, you're going to end up losing in this game. So we talk about conglomerate discounts. This might be another reason too. Is if you grow by acquiring other companies and you're making your company safer, you're essentially rewarding the previous lenders who now charge interest rates that are too high given the type of company you've made yourself. So that's the abstract example. Let's think about how you can apply it to a real company. I'll tell you which of you will find this approach a way to value the equity in your company. If you have a company that's a money-losing company, how many of you have money-losing companies? Okay, keep your hands up, because I'm going to ask you a second question. That'll tell you whether you have to do the option pricing. So you're hoping your hand is not up after I ask you the second question. How many of your money-losing companies, or how many of you have money-losing companies with a lot of debt? Okay. Those are the three guys who are going to be doing the option pricing model. Just money losing is not going to do it, right? So this is a good thing. You get a chance to try it out with no consequences, right? You're not putting any money in it, might as well. And it'll take only about 10 minutes to do, so it's not difficult to do. You see why you need the second component? Because for equity to have the option to liquidate, just a money-losing company doesn't do it. Because Twitter, there's no optionality in liquidating, because if I liquidate, there's no debt to pay off. So you need both money-losing and a lot of debt. And a lot of debt in terms of your debt ratio is about 40, 50, 60%. Then you're really talking about debt becoming potentially catastrophic. You have an option on your hand. So let's think about how we would value a company like that, how we'd get all these inputs. Because in this abstract example that I just described, I gave you the numbers, right? I gave you the value of the assets, I gave you the face value, I made a nice zero coupon bond. The reality is when you look at companies that are distressed, you're going to get multiple claim holders. You get convertible debt, preferred. Basically they borrow from everybody and their brother because they're desperate. You're not going to get one nice zero coupon bond. You're going to get dozens of debt issues with different coupon rates and different maturity dates. Okay? Your debt is almost never going to be zero coupon debt. Okay? And finally, you don't know the value of the firm. So everything we assumed in the abstract example is not as easily accessible if you're looking at an actual company. So what I'm going to do is take you through the process of estimating these numbers if you have distressed equity in a company out there. Let's start at the top. You want a value for the firm. I'll give you the good news. If you've done your DCF valuation already for your company, right, you already have a DCF value for the operating assets, Glencore. That's your S, you're done. If you haven't done that, or you're looking at another kind of company, not something for then the other way you can come up with that S is by adding up the values of the individual assets they have. So if you have a real estate company, 5 properties, you can add up the values of the properties. You might attach a liquidity discount in the sense that if you sell all of this stuff quickly, you're going to, if you want to, so the S here is what you would get if you sold all your assets today. So that's a key perspective. So don't bring in any growth expectations and good stuff happening in the future, because you're not going to be able to liquidate it today. So S is the value of the assets if you liquidate it today. For the variance in firm value, there are a couple of things you can do. One is you can look at the variance in stock prices and bond price of your company. Glencore, for instance, stocks are traded, bonds traded. They can take the standard deviation of the two, try to come up with the standard deviation for the company. The only problem is when you're distressed or your debt and equity would start to behave in strange ways, your standard deviation might not be that reliable. So I'll give you a cheating way that's going to take a lot less time. What kind of business is Glencore in? It's a mining company. If you go to my website, I give you the standard deviation firm value for a typical mining company. Just like a bottom-up beta, I give you a bottom-up standard deviation. Just use it and move on. It's a lot less work, and it's probably more reliable than trying to build up to a standard deviation. So you could do that. If you feel that's too simplistic, then try this. Remember the Monte Carlo simulations I suggested you could do for commodity companies? If you want to do that, and you can get a Monte Carlo simulation in values for Glencore, which I'd strongly recommend you don't start on now if you haven't done it already, then you can use the standard deviation of that value. You can get it in one of those three ways. So that's the variance in firm value. For the value of the debt, I'm going to cheat. You look at any distressed company with a lot of debt, I'm going to see dozens of debt issues. In my abstract example, what did I have? I had one nice zero coupon bond, right? So what I'm going to do is I'm going to take all your debt issues, consolidate them, and convert it into the equivalent of one zero coupon bond. And here's what I'm going to do. Remember, these different debt issues each have a duration. Remember the definition of duration? Essentially, it's like a zero. If you were converting your coupon bond into a zero coupon bond, the duration would be the maturity of the zero coupon bond. So I'm going to take each of your debt issues, come up with the duration, take a weighted average duration of the debt issues, and act like that's the duration of my zero coupon bond. I'm going to take all the debt you have coming due and treat it like the face value that's due at the end. It's cheating because I know you have coupons in 6 months and a year, but I'm taking all of your debt issues and converting it into one zero coupon bond. And then for the duration, as I said, I'll just take a weighted average. If I do that, I'm going to end up with numbers that look very similar to my abstract example. So let me try this. You familiar with the Eurotunnel? That hole in the ground where cash goes in but never seems to come out. Built with a lot of promise. When it was built, the British and the French government were already counting out the profits they would make from the Eurotunnel. It's never made money. So this was a valuation I did of Eurotunnel in 1997. So let me establish my case for why I think the option pricing model is going to work. It's losing a lot of money, so it meets criteria 1. How much money? It had lost £56 million in earnings before interest and taxes, and a net loss of £685 million. So it's losing money. Its book value of equity was negative, which tells me what? That it's been losing money for a long time. So it's losing money, it's been losing money for a long time. It had never made money, to be quite honest. So condition 1 met. It's a money-losing company, and it's losing money in spades. What's the condition 2 that I have to... Does it owe a lot of money? God, does it owe a lot of money? It owes about £8.9 billion. And in fact, I broke the debt down into 4 groupings. They had dozens and dozens of debt issues into really short-term debt, 10-year debt, 20-year debt, and longer than 20 years. That's how much debt they have due. I basically attached a duration. If you don't feel like you can get the duration, just use the maturities. The weighted average duration of their debt is about 10.93 years. Do you see what the game I'm going to play? I'm going to act like they have one zero coupon bond with an $8.9 billion face value and 10.93 years to expiration. So I've got the value. I've got the conditions I need to apply option pricing. What do I need to get started? I need a value for the underlying assets, right? So here's what I did. I did a conventional DCF valuation. Projected out revenues, earnings. And I was as optimistic as I could get about a tunnel where you don't have much pricing power because the government's put pressure on you. I ended up with a value, and think of this almost as a best case scenario right now, of £2.3 billion. How much do they owe? £8.9 billion. The value of their operating assets is £2.3 billion. We are looking at a D part of the money option, right? For your equity to pay off, what has to happen? The value has to climb above £8.9 billion. In case you ever decide to liquidate, you get to keep the difference. The one thing you have going for you, though, is you have 10.93 years before the day of reckoning kicks in. One final number, I needed a variance. In this case, I could not find too many publicly traded companies in this space. Today, actually, you can find toll roads and publicly traded infrastructure companies. In 97, I was forced to use Eurotunnel's equity, which had a standard deviation of 41%, and Eurotunnel's debt, which had a standard deviation of 17%. It was about 15% equity, 85% debt in terms of proportions. There's my variance in firm value for Eurotunnel. Again, remember what I said about variance. 0.0335 looks like a really small number. But remember, it's percentage squared. It's really 335% if you are stating it in percentage terms. So there is variance in the value coming from the cash flows being volatile. I have everything I need to value the option. Value the underlying asset here is £2.3 billion. It's my DCF valuation. The exercise price is the value of all the debt I have outstanding. I've converted the equivalent of a zero coupon bond, £8.9 billion. The life of the option is the 10.93 years, which is the weighted average duration of the debt coming due. The variance is 0.0335. The riskless rate was 6% at the time that I did this. I plug the numbers in D1, D2, N of D1, N of D2. What's the probability that Eurotunnel will not make it? 92.5%. So walk in with open eyes. There's a very, very high chance that your equity will be worth nothing. But here's the miracle. This is a deep, deep, deep out of the money option, right? The value of the operating assets is 1/4 the debt that you owe. But look at the value of the equity. It hangs in there, 122 million. That's why I characterize equity as this incredibly stubborn instrument. Its value hangs in there, and what's keeping it afloat is the fact that so much of the debt is really long-term. A lot of natural resource companies, mining companies, oil companies, in the next year or two, if oil prices don't bounce back and commodity prices are going to trade more like options than they are going to trade like conventional shares. And when they trade like options, you got to treat them like options, which means when commodity price variance increases, your option value goes up. It's not a question of level alone. It's now going to be a function of variance. But in this case, it's the fact that you have really long-term debt that keeps this option afloat. And you have one added bonus here. Much of this debt is debt that was given to them by British banks and French banks. And every time debt comes due, guess what the British and the French government do? They put pressure on the banks to extend the loans. Like having an option where people keep extending the life of the option for you. That's an incredible bonus to get. So it's things like that that keep the equity afloat. So I'll actually send you a list of companies that are officially basket cases. And there are quite a few out there. Where you say, and they're often subjects for news stories where people say, well, how the heck do people even invest in these companies? Are these people crazy? They might be. You can never rule that out. Or they could be just option investors. They're investing in these shares for the reasons you invest in deep out of the money options. It's a different perspective of investing. So have you heard of vulture investing? Vulture investing is all about investing in companies like these. So to close this process off, let me ask you a question. So let's say you decide to start a fund. You say you're supremely excited by this prospect. I can see the optionality is what you want to do. So you decide to start a fund and you say, I'm going to take advantage of it. Okay? So you start screening for companies. First, you want companies that are losing money and have a lot of debt, right? So you go into Capital IQ and you look for companies that are losing money and have debt ratios that exceed 60%. You're going to get about a few hundred companies. Now I'm going to ask you questions about the debt and about variance and where you'll be focusing your search. Let's start with the easy one first. You have a lot of money losing companies, a lot of debt. Do you want to go into sectors where there's lots of variance or low variance? You want to go high variance. So basically you want to invest in companies that are losing money, that have lots of debt in risky businesses. In Capital IQ, you can also check out the maturity of the debt, the weighted average maturity of the debt. Do you want to invest in companies where the weighted average maturity of the debt is low or high? So basically, you need 4 screens, right? Money losing, lots of debt, high risk, long-term debt. And what are you going to do? Buy one of those and hope and pray? No, don't do that. Buy 50 of them, because these are deep out of the money options. What you hope is that the portfolio is what's going to carry you through. You buy 50 of these options and hope and pray. Nothing more you can do. I mean, it's not like you can influence oil prices or commodity prices to change. Hope and pray. And if you're lucky, maybe 5 out of the 50 will pay. That's a really good hit rate with deep out of the money options. Maybe only 5 out of the 50 will pay off. But those 5 will make 800, 1500, 2000% returns and carry the rest of your portfolio. This is not a high hit rate portfolio. It's a skewed portfolio where a few investments are going to be what's delivering returns for you as an investor. So it's one way of thinking about distressed equity investing is you're investing in options and essentially you're looking for deep out of the money options that you think are cheap. and effectively creating portfolios and hoping and praying that those portfolios pay off for you. Okay? You need to have long time horizons for this to work out, because if you need liquidity and you sell 2 weeks from now, it's not going to. But if you have the time as your ally, you essentially can hang in there and hope that these options, at least some of them, pay off enough to cover all the losses you're going to have from those options that don't. So let's summarize everything about real options. There are options everywhere. Let's start off conceding that. Everything is an option. Most of these options you shouldn't care about because they really don't have much economic value. The key word, as I said, is exclusivity. If you and only you can do something, the value of the option is great. If lots of people can do the same thing, the option value dissipates. Third, when options have significant economic value, whether you can use option pricing models rests on whether the underlying asset gets traded and the option gets traded. If they're both traded, you're on easy street. You can use option pricing models. If neither is traded, which is often the case with a patent, then you're on much more dangerous ground. It's not that you can't apply option pricing models, they're much more difficult to monetize. And the real value from options to me is not in the number crunching, but in the insights that come to you. Insights about what kinds of companies to invest in if you're investing in distressed equities. Insights about how to run a company in terms of capital structure, or if you're growing through acquisitions. Those are the things I hope you take away from these sessions, because those are, I think, the more critical pieces of learning out of these processes and actually plugging numbers into a Black-Scholes and saying that's the value of the option. Okay? So that's pretty much it. Before the next class, though, the next session is on acquisitions, and I'll give away my bias with my title, and I'll give you the history for this title. About 7 or 8 years ago, a friend of mine who runs these executive seminars in New York was running one for a group of serial acquirers. You know what serial acquirers are? They're like a book of the month club. They're CFOs of companies that buy another company every month. It's almost like that's a habit. She's running a seminar for serial acquirers, CFOs of these companies. And he called me and he said, will you come in and talk to this group? And I said, are you sure you got the right guy? You know what I think about acquisitions, right? He said, no, I really wanted to come in and talk to this group because for the rest of the day, they're going to be hearing from investment bankers. You know what investment bankers think about acquisitions, the mother's milk for all deal making. And he said, I'd like you to come in the last half an hour of the day and be an antidote to the rest of the day. And I said, don't worry, leave it to me. And I ended up with the session. So what I'm going to do is, actually the way I structured the session was I set them up with 7 tests. And I offered them a challenge that none of them took. I said, I'm going to pass you through 7 tests. If you fail more than 2 of the tests, I'd like you to stop doing acquisitions right away. Nobody took me up on the offer. If they had, half the people in the room would have had to stop right after this. So I'm going to send you those 7 tests before the next class. So think of that as pre-class, start of the class. So it's going to be during the class. We're going to pass through all 7 tests. If you can if any of you are planning to go into M&A and you fail more than 2 of these 7 tests, I hope you will reconsider. Right? But I'll send you the 7 tests sometime towards the end of this week, okay? And more details about the final exam.
I just want to ask whether the options pricing model will be on top of the DCF. So it's going to be 3 values.
And the height of the option pricing model is valuation.
Yeah, so if you go to My Program Progress, it shows you the